Good afternoon, everybody. Thanks for coming on by. Today, we're going to start a little something that we've kind of done in the past, but a little different. We're going to call it Tequila and Technicals. So basically, all we're doing on this segment is talking about technicals and where things are at from a technical perspective. If you want to join us for more or different types of trading, for example, in the Steam room, which is primarily swing to long-term trading, and or the 0-day room, which is more for scalping, you can join us in either one of those spots. For purposes of what we're looking at today, I'm just going to kind of give a brief overview of how I use technicals and how you can use them. And then if you've got some names that you want me to look at after we go through kind of my breakdown, happy to throw some names out there, and I'm happy to tell you what I think of them on a technical level. So that being said, let's just start with technical analysis. And technical analysis, to me, basically means, okay, is a particular stock or index in an area where I might have an advantage to either be long, short, or neutral on a trade. And a lot of that has to do with timeline as well. So for example, right now, what we have up in front of you is the SPX on a daily chart. So kind of how I start with technical analysis is I need to make a determination whether what I'm looking at is trading or trending up, down, or sideways. So the things that are important to me as far as landmarks are concerned are things like the 200-day moving average. So on this chart of the SPX, this rising red line is the 200-day moving average. This blue line over here, which is currently in a zone of flattening, is the 50-day moving average. Those two moving averages get used quite broadly and quite often as areas of landmarks. It doesn't necessarily mean this is a trade and this is an area for you to take a trade. They're referred to by us as areas of interest, right? So for example, the SPX currently is trading below the 200-day moving average. Typically, from an institutional standpoint, that would signal an institution to say, hey, I might be interested in the SPX here. And whether that's long, short, or neutral, what they have to do is make a determination of, okay, can I figure out, is there a trend, right? So if you look at the price of SPX over time recently, we really haven't gone that far. We're inside of a zone, right? You've got a high of, just call it 7,000, and a low. The low that was over here from November was breached on Friday, but bounced back up. So kind of, I'm going to take this little line right here. I'm just going to move it like right down to here. So this is approximately the zone that we're trading inside of. Can I get any clues from the moving averages as to what the trend is on the S&P 500 right now? Well, obviously, the price is below the 200-day moving average. The 200-day moving average is still trending up, but price is below. The 50-day moving average is curling down, and the other average shorter term that I like to use is the 20-day moving average. That is obviously curling down. So I would say that this market is negative to sideways trending. So once you know what the trend is, or if you can identify a trend, it helps you lean on, well, do I want to be a long, a short, or a neutral type of trader? And what type of strategy and time frame do I want to utilize? And then, of course, in this environment, there is really no such thing as leaning on technicals to give you a really solid indication, because right now we're in a headline-driven market and price really isn't getting us anywhere. So if you look at this right now, you would say, hey, you know what? Short term, with these overhead indicators keeping price locked in, there's not a ton to be positive about from a technical analysis standpoint. If you just wanted to take a chance and say, hey, listen, we're at an area where we're just oversold, we're due for some good news, and I'm just looking for a pop, that's fine. You can make that statement and you can trade like that. But once you do that, you're not trading according to technicals. And we all know technicals, like anything else, fundamental analysis, analysis of economic data, et cetera, it's only as good as the environment allows it to be. So right now, technicals are not really saying a whole lot in a whole lot of names and indexes. So that being said, let me just pump up another couple of names here and give you more ideas about what I mean about a trending market or markets that are in trends. This is ASML. ASML is a semiconductor company, lithography. It's equipment that's needed to make the high-level chips, the 4 nano chips that are sophisticated in nature and difficult to make. So if you take a look at where the technical picture is on this. You've got a rising 200-day moving average, a flattening out 50-day moving average. So from a longer term perspective, I can make a statement that says, you know what, ASML in a longer term is still trending higher. Could it come down to the 200-day moving average inside of a trend that indicates it's going higher? Absolutely. So you got to be careful about what type of time frame and an area that you pick to look at buying something shows up. Let's look at another popular name, like an NVIDIA. So an NVIDIA has a very similar look to what SPX does, and primarily because it's made up. A lot of the SPX, look at where the 200-day moving average is. It's below price. The 200-day moving average is starting to flatten out. The 50-day, the 20-day are curling down. So you're getting price that's kind of getting locked in here. And if you look back over time on NVIDIA, I would say that this is a neutral trading stock. It's trending neutrally, right? So if the 200-day, the 50-day, the 20, if they all come together and they all start to trade sideways like that, you have a very sideways trend. So there's not a whole lot of advantage as far as entry is concerned on a name like NVIDIA long term. It's just neutral. It's okay. There's nothing strong about it. There's nothing weak about it. Could it all change and could it run higher? Absolutely. Could it all change and run lower? Absolutely. You're kind of at a spot where it's trying to figure out what it wants to be when it grows up. Let me see if I can find a couple of other popular names that are not necessarily tech related. This is Lilly, right? So take a look at Lilly. Kind of the same thing. You've got a rising 200-day moving average. Currently, it's supporting price. Is it going to hold up? I'm not sure. From a shorter term perspective, the 20-day, the 50-day are overhead and descending. They're declining. They're keeping price penned in. So if you want to be a buyer of a name like Lilly and you buy in an area like the 200-day moving average, and let's say you want that for long term, if the stock were to break below that 200-day moving average, for me, it would be a signal and an indication that it's just not ready to be bought yet. I would more than likely close a long position if that were to happen. But if you looked at this name and you thought, well, I want to find something that I think is quality that's at a discount and that the trend still looks okay. Like this is not, the overhead from a short-term perspective is not fantastic. From a longer-term perspective, it's okay. It's not fantastic. It's okay. So if you bought that here and the stock went below this most recent low here, just call it 898, 899, I'd probably sell it and wait and see if these other averages over time catch up. We can show you a name that we tried trading earlier in the year. And I think we weren't the only ones, right? We looked at UNH.
Ron, not to cut you off, but when you are ready, let me know. There's some names in the chat that you can go over when you're done with UNH.
Oh yeah, sorry. I was just trying to give some examples of how to
no, you're good.
Trend.
Yeah, keep going. You're good.
Okay. So like a name like a UNH. So this was one that obviously had bad news, destroyed its technical levels and broke completely down. So over time, we tried to get involved in the face of technicals that were telling us it's not the ideal spot, right? And now what you have over time is you finally have a lot of these technicals starting to catch up. Your price is still below these technical averages. So is it a great spot? I don't think so, right? So that's kind of how we go about using the technicals on a long time frame to try and make a decision about, hey, are we in a spot where we might be able to take advantage of something from a long-term or a short-term perspective? So for example, the UNH, I wouldn't be a buyer of that. Like we tried once, it didn't work, and it's unlikely that it would work right now, at least in the current environment. Joe, you said you've got some names that are coming in. Go ahead and fire up some
Yeah.
names.
Yes. The first one. Oh man, Iron Man Trader's in here too, which is one of our guys, and he's looking at a name I look at. First one is Wix. WIX.
All right. So look at this on the daily, right? So I would say that this is a stock that currently is in a downtrend. And why do I say that? Because the 200-day is well overhead and far removed from the 50-day moving average. Currently, price is supporting at the 50-day and the 20-day. So if you wanted to buy something here, I don't have a problem with that. The question is, how long do you want to stay involved? I kind of look at the averages right here and say, all right, if I buy here and I break below this spot here, I'm probably just going to cover, take a small loss, and wait and see if the 200-day moving average over time catches up and is it a buy? The other caveat to this, I would say, is if you're going to buy this and your expectation is that the price of this stock is going back to its highs, you have to temper your expectations. Like I would say, if you bought it and it went for a run and you got to the 200-day moving average, I would call that a successful trade and I would close it down. Some people have expectations that no, this is going back to highs. And by the way, that's fine. I don't have a problem with that. It depends upon what kind of vehicle you use. Are you just trading equity? If you're using options, you get different choices to make. If you get a run up to here, you can roll to a different strike, because if you have a belief you're coming back up here or you're coming back up here, you can stay in the trade by rolling strikes. In this current environment, I don't know that I would trust it, right? Just because of all the headline risk. What else we got, Joe?
Next name that we got is going to be Rocket Lab, RKLB. That's from our boy Blue in the room.
What's up, Blue? All right, so take a look at Rocket Lab. The longer term picture, the 200-day moving average is currently supportive. Look at the number of touches that Rocket Lab has had on its 200-day moving average, and it has supported price and trend. The only thing that bothers me a little bit is this 50-day moving average overhead, which is curling down, and it's currently keeping price in check. It doesn't mean that will hold, but it's kind of a prove it to me that you can get through there. Look at what's happened at the 50-day moving average. This was a little bit of a head fake, and then here price keeps price in check. This really never even made an attempt at it. Same thing here. If you look left, it's kind of an area of price structure where you run out of supply, right? And then there's no more demand for it, and it sloughs off. So is it a good buy here? It's possible. If you look at 6406 as an area of support and the 200-day moving average as a support level, it's not bad from a longer term perspective. Shorter term, there's some turbulence here because of these other moving averages currently keeping this in check. And then again, the caveat is it's a headline driven market. So how well does this stock move given the headlines, right? It certainly looks like it moves a little bit less. It's a little bit less volatile than the indexes, but that comes back to your individual comfort with it. You know what I would say, listen, if this thing sold off to the 200-day moving average, that would probably be a really nice spot for an entry. So in here, it could work, but you probably need to get out of the way if you break that 64 area, unless the 200-day moving average comes up to support that price, which is going to take a little while. What else you got, Joe?
Next one is RKT.
Similar industry, right? So I would say that this is a broken trend. And why would I say that? Well, you've got a, let me just get rid of this because that's going to cause confusion. All right, so you've got a 200-day moving average, which has broken down. It is no longer supportive. You've got the 20-day moving average sharply moving lower, the 50-day moving average also sharply moving lower. I don't see an advantage to the long side here. You have a catalyst event that's coming in April. So maybe there's an opportunity when you get to the catalyst event, but right in here from a technical perspective only, I don't see much edge in getting long here. Would I get short? I don't know that there's a lot of edge getting short either. Why do I say that? If you look left on the chart, look at the price structure that exists in this area. It's probably trying to be defended, but you could flush out. You could make an argument that this could flush out to here because this trend is broken right now. What else we got?
IWM.
Oh boy. Another tough one.
This will be fun for you, Ron. I'm curious what you have to say about IWM as well.
It's another tough one. All right. So again, longer term trend currently still intact. Test of the 200-day moving average. Shorter term, 20-day. Overhead price declining. Same with the 50. So it's probably a game of ping pong in between here. So if you're looking and you want IWM, and it's very difficult to do, is to buy it on a red day close to or at the 200-day moving average. You take some risk there. You get a pop, and you probably look to sell it and rinse repeat, because this is a very difficult market to use technicals in, just for the simple standpoint of any headline at any time can completely destroy your thesis using technicals, right? Technicals are only as good as the market that you're in. And if you're in a market that's all headline driven, it's very difficult to anchor to technical analysis. What else you got, Joe?
Well, we got a lot, so let's keep on going. First, the real next question is they're asking, where's the tequila?
You know what? I'm on the West Coast.
So Ron's like, it's 1:30.
It's 1:30.
I didn't crack it out yet.
So if I bust out the tequila now, the day's over. It's only
we can
1:30.
also talk about the tequila though if you guys have questions. That's where Ron is a tequila connoisseur. Next name is EOSE.
Now this is a name that we see in our room, and it does catch sweeper activity. I don't know of late, but I can look at this chart and say that that's something that to me is currently in a downtrend. It's a long-term downtrend. You've got the 20-day moving average keeping price in check. The 200-day moving average is flattening, keeping price in check also. Same with the 50. Now, if the 50 crosses over the 200, which it looks like it wants to do, there's a term for it. They call it a death cross, and it signals that the stock is going to go lower, right? But it's already happened. So I don't know how good that is. If you hear somebody throwing the terminology around, go check it out and see if it's already made a move like that. I don't know how much more downside you get based on looking left at all of the price structure. Could you get down to here? You know, maybe, but I don't like, you're going to risk at $5 to close at 3 seems crazy. If you want to get long and you're like, I just want to tuck it away. For me, I don't like that kind of a tuck away type of trade, not in this environment. If it's a different environment, I would change my mind. Right now, I can't do it. So you got earnings in May. If it were me, I'd be looking at it saying, all right, let's just keep an eye on it. I'll set an alert. And when May 12th comes around, I'll check in and see how they're doing. The other thing that I kind of look at with the technicals is, all right, well, did they make any money, right? They didn't make any money. Are they closing the gap? Whew, not really. And then that's pretty schizophrenic as far as the fundamental actions. And then the technical analysis basically tells me it's a do not touch.
Ron, if you were, and we will do some sipping on some tequila on these for sure. But if you were to sip some tequila right now, what would you be drinking?
Okay, let me show you what
get us a bottle.
I'll show you what's in my rotation.
Let's take a look at the bottle. I'm always curious what Ron ends up doing because he always sends me recommendations all the time.
All right. Here we go. Here's in the rotation.
There, pop it on the screen. I'm going to show them real quick, and then we'll get to the next name, which will be Celsius.
So this is G4. This is a Reposado. And also currently drinking the Ocho.
The Ocho. That's the one that you told me to get. I have a bottle of it here.
Excellent. This is also a Reposado. And then
there we go.
The other one in my rotation right now is Arete. also
Okay.
a reposado. So what do I like about these tequilas? Well, number one, they're additive free. So if you're a fan of like Clase Azul or what's that god awful one that Clooney makes?
Oh, is he Casamigos? Yeah.
So a lot of those manufacturers, a lot of those labels will put additives into their tequila, like scents, like vanilla and cinnamon, or they'll flavor it. And really, all that does, in as far as I'm concerned, is just create more pollutants for your body. It's bad enough as it is. So why do you need to add more? So
why add some more inflammatories?
exactly. So I like them additive free, and I like a little repo on a big rock at the end of the day.
Nice. We love that.
Yeah. But like I said, out here, I can't start sipping at 1:30.
Well, we're gonna force him to do it, guys. Don't worry. We're gonna get Lucci in here. We're gonna start ripping some shots one of these days. All right. Next name is Celsius, which I'm curious about this name too, because you know me, I have been sitting in Celsius for years on an equity position, longer term, CELH, and I still have some trading around this. But Celsius is an interesting name.
Yeah. So from a technical perspective, what's tough about this name is that it is more reactive to headline news and has like these big swings, and you can see the gaps. Like there's a gap on earnings, there's a gap on earnings, there's a gap. Like it's a tough name to apply technicals to, and it's a tough name to apply fundamentals to because they're all over the place, right? It's like it's like a teenager who hasn't eaten all day and then has a couple of White Claws before they go to the prom. Like it's just messy, you know what I mean? So it's difficult to apply technicals or fundamentals in here. I kind of like the price structure if you look left and you see structure here. But from a technical perspective, here's what I was kind of talking about when the 200-day and the 50-day all kind of meet up. So on any given day, if price is above, you're bullish, and currently the price is below. So you got to stay bearish until that price can fight its way above. That's how I look at it. So some traders like to say, you know what, it's a dip and it's going to pop back up. God bless you. Have fun. I don't trade that way. I let the technicals help support the longer term picture. And when they don't, or if they don't, I just avoid it.
Yeah, I as someone who's been trading Celsius for like 2 years now, it's a tough one.
It's hard.
It's not easy to trade. Next name, ONDS.
Ondas. Okay.
Man,
you notice
so
how
many
a lot
consolidating names, man.
Exactly. Do you guys see what's happening here? So many of these names that you're asking for, and we pull up, they've either been sold off and they're trying to consolidate and the technicals are trying to catch up, or they have a look like this. The 200-day moving average is still rising. So the uptrend is still there, right? So longer term, you can say this is still in decent shape technically. However, is this a spot to buy it? Well, look at the structure. It has not been able to break through the 50-day moving average with continuation. Sure, there are days where it pops above it. And if you're trading and you're like, you know what, I just want to buy it for a pop up to like an area like this, that's fine. I don't have a problem with that. The question is, how long do you want to be in the trade? And are you comfortable taking it here, knowing that you might have to allow for price to decrease all the way like to a level over here? Like to me, that seems like a lot of unnecessary risk. You wait for a day, like I would set an alert. Like I would just do something like this, like an alert, crossing down. Like you really love it. Maybe you want to wait for a day like that, or a day where it comes to the 200-day moving average. Maybe you move it down here and then you look at it and say, okay, do I want to see if I can catch it for a bounce? But up in here, there's just not a lot of edge when things are consolidating and trading sideways. I mean, there is, if you can trade a condor, and if you can get a condor to pay on a $10 stock, you're not going to make any money.
And this would be a good time to add, like for those that are interested in trading with Ron, he does a members only segment once a week where they break down condor trades, leaps, positions that he's looking at, and looks at names like this, but he'll give you actual suggestions on how you could potentially trade it. So if you guys are interested in that, we're running a promotion for the next week here. 7 days free, 50% off your first month with code WSJ50. WSJ50, steamroomtrading.com. Go there. This is what Ron does usually every Wednesday. Next name for you, Ron, is going to be DOW.
Dow Chemical.
Dow Chemical. This will be a little bit different, not as consolidated.
Right, there you go. All right. Now, what you can say about this from a technical perspective is you have a rising 200-day moving average, a rising 50-day moving average, a rising 20-day moving average. This is a stock that is currently in a solid uptrend from a technical perspective. So in days where you get weakness, the 20-day moving average is probably an opportunity to buy. Same with the 50, same with the 200. So that is a good example of a stock that's currently in an uptrend, and they're hard to come by. So like if you like this name and you're in it long term, I think you're good. It depends on where you entered. So if you entered somewhere down here, you've got a lot of cushion to work with. If you entered up here, I don't think you need to press any panic buttons, but you are going to have to either allow yourself the grace to let the stock drift back down to one of these areas to see if it's going to hold up and or add. But I'm not a proponent of adding on dips. I don't average down. I try to wait for days where there is ugliness and you come to one of these areas, and I like to buy in those spots. And then if those spots don't hold, I get out of the way.
Next name is Open, OPEN.
Open Door. Okay, now this is an interesting one from a technical perspective. This is something, and price-wise, yuck. But from a technical perspective, and I'll add a little twist to this, you've got a rising 200-day moving average. The 20-day moving average has flattened out, rising. The 50-day moving average is starting to flatten out. From a technical perspective, we refer to this type of action as a pinch. It means that the indices are pinching, and oftentimes what happens is in a zone like this, it'd be like a beach ball underwater. The longer the consolidation goes on, and when the technicals improve, the potential for a move higher, the probability starts to build for that type of activity to happen. It doesn't mean that it's going to. It means that from a technical perspective, you have advantage. From a fundamental or what happens in the market on a day-to-day basis, anybody's guess, right? From a technical perspective, that gives a little bit of advantage. Now let me throw the twist into it, and the twist is going to be this. You have a move from a low to a high, and I'm going to measure it with a Fibonacci tool to see, and I'm willing to bet we're very close to a 50% retrace from low to high. Okay, so from this low to this high, you have the price retraced all the way back, and here's 50% of the total move right here at $5.70. So that's something to also keep in mind. So the question is, can the stock, if you buy it here, get through this little area? This little area right here is a 50% retrace. So to me, that type of move is a normal one. It's a rational one. There's nothing rational about markets in general, but there's a little bit of normalcy that you can throw at it. So if you like this as an opportunity to break through that 567 level, my opinion is, sure, you can do that. And if you take a closer look at the price off of the 200-day moving average, and let me just move this down just a little bit, you're going to have to give this a little bit of grace, right? So look at how much it's around, and keep in mind, these are guidelines. Like, you can't make a statement like it's going to touch the 200-day, touching the 200-day moving average, I'm buying it on that spot. You can, but remember, there's nothing exact in this game. It's an area. It's an area of interest. It's an area of currently support. So if you bought it, you probably don't want to let it get past this area here. And on the extreme, this area here. And if it does do something like that and you add down here, you're putting yourself at risk. Why? Well, when the price was here, you were much closer to the 200-day moving average. If price comes all the way down here, now all of a sudden you're far away from the 200-day moving average, making it harder technically to catch up. Hopefully that makes sense.
Next name, a favorite, ServiceNow, NOW.
Oh man, this is
that reaction.
I know. Well, this is so difficult, right? And the reason this is so difficult, and one of the reasons I believe that technicals are broken in a name like ServiceNow is because all of the SaaS names have been under a tremendous amount of pressure. I don't know that technicals are really going to help in an environment where it's been beaten up so much, right? I think there's a very uncertain future in SaaS names. Who's going to survive, who's not. I think personally, ServiceNow is a good name and it probably does survive, but I don't know that. I have no idea. What I can say is from a technical perspective, the only way I would be comfortable buying this is by saying, you know what, the technicals are horrible, but I don't care. I'm buying ServiceNow. That's the only way that I could do it. If you were to step in and try and buy this here, and you can kind of see when I threw the Fibonacci tool on the last one that we looked at, this is probably going to be the same kind of setup, right? You had a low down here. You have a high right here. You have a retracement. There's your 50% retrace all the way down to the 38% retrace. It's got to hold. It's got to hold in this. And why is that? Because the bigger picture technicals, the 50-day moving average and the 200-day moving average, are far above price, keeping it penned in, right? And look at the 20-day moving average, it couldn't regain it. So from a technical standpoint, I don't like it. Are you just going to take a shot down the field because you want it in your portfolio because you think it's going to be a winner somewhere down the road? Yeah, it's sure, no problem. I would say just make sure that you're thinking about how many of these types of names you want in your portfolio. And you could be sitting on that pile of names for a very long time, waiting for them to recover when and if they ever do. And when and if the broad market recovers or other names recover and you miss out on other names that you could have been in that are stronger, it's very painful to sit in those positions and watch everybody else run outside with their fucking ice cream money and get the fucking double bomb pop while you're sitting inside crying because you spent all your money on trash. So that's a tough one. Very tough. Any of the SaaS names are tough.
Next is Target, TGT.
Okay, another one that you guys have found that is in quote unquote an uptrend.
Not broken.
It's not broken. You've got a rising 200-day moving average, a rising 50-day moving average, and from a shorter term perspective, a 20-day moving average, it's flattening out a little bit. So if you like this longer term, I say, okay, you buy it. And then this is your cutoff point right here at this 112.5 area. Now, the hard part about that is you might buy it and you'd be like, well, freaking Ron said cut it at 112.50. And as soon as I cut it, it went higher. Like, that's why I like to wait for days that are ugly and test those moving averages to buy, because I don't want to have to average down or cut for a loss. I want to buy it on a crappy day at a decent technical level. And if it doesn't work, I tip my hat and I move on.
Netflix.
Oh boy. This one's been hard. And again, we're not in an overall trending market. And Netflix just went through that whole thing with Paramount. Is that right? Did I get the name right? Was it Paramount?
Yeah, there's a bunch of stuff. Warner Brothers, Paramount, Netflix is a whole.
So all that stuff resolved down here. Now, this is a great example of a name that moved based off of fundamental or catalyst information, right? It sold off from a technical perspective. It was like textbook, right? Sell, 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 sell. And then you get an event. And I don't know if anybody would have been able to see it coming or not, but you got that event, and then they took the pressure off, and you got this move. So this move had nothing to do with technicals. It had to do with, hey, technicals suggest it's a downtrend, and then you get a news headline, and boom, it rips up through, defying the technicals and giving the technicals the middle finger. That's the weakness in technical analysis. You don't know when stuff like that's going to happen, which is why if you look at a name like ServiceNow and they get some kind of news that helps them, these technicals mean nothing. They mean nothing. They go out the window. If you're in a trending environment and the technicals are behaving and acting well, we had that for the last how many years, Joe? Since like 2008, right?
Yeah.
And the post-pandemic, those were fantastic trending markets. I mean, they'll probably come back, but who knows when, right? Who knows when? So Netflix, shorter term, if you like it here, you take a shot at it. You've got a supportive 50-day moving average. What I don't like about it is you've got a gap right here, and this gap hasn't been filled yet. So the rule about gaps, and it's a guideline, it's not a rule, 80% of the time gaps fill, 20% of the time they don't. 80% of the time when a gap fills, it reverses direction. 20% of the time it does not. So from a long-term perspective, if I'm a buyer somewhere in here, I cannot let price slide below this little area right here, because if I do, I'm now in gap fill risk, and I don't want that risk. So if you buy it here, the line in the sand is here. I think from an upside perspective, maybe you get a run at the 200, the 50 supportive, the 20-day is supportive, but on any given day, this thing can do weird stuff. So it's a hard trade. You've got gap risk.
Next name is Intuit, INTU.
Similar looking setup, right? And Intuit is, somebody help me, is Intuit considered a SaaS name?
Yes.
I mean, shorter term, you're getting a pinching effect of the 50 and the 20, but look at the price on the 50-day moving average. It can't get through. So it's another one of those prove it to me. And if it can, like, how long term do you want to be? Look at this move over here that trapped everybody trying to get gap fill. It didn't fill, and it reversed. One of those 20 percenters, right? Flush. You got another gap up over here. I'm sure traders are looking at it thinking, hey, if I can catch this thing and get some of these gap fills, it's a nice trade. And I don't disagree with that. The question is, how much risk are you willing to take, and where are you going to cut it? So I would say you wait for a bad day and you look for the 20 to support, and maybe that's your entry, and then see if you get that pop. And the worst case scenario is, let's say you come up to the 50 and that's all the further you're going to get. Take your money, or you know what the range is, but the 50 and the 20 are going to start to pinch together a little bit. Certainly not as gravitational as if the 50 and the 200 were pinching together. And that's because these have more, the 200-day has more weight to it, because that's where institutions are paying attention, as opposed to the 50 and the 20. What else we got?
INVX.
Is that a biotech? All right. Stock with an uptrend. However, from a shorter term perspective, what's going on here? Trading view. Nope, don't want that. Hang on. Sorry, we just had a little trading view Tourette's there. Shorter term picture doesn't look great. Longer term trend is still there. It has previously held up on the 50-day moving average. It's currently not doing that. So to me, it's a prove it. Prove you can get above there. If you like it long and you want to take it here, not a problem. I would say you get out of it at 23, this low right here, this 2364 area, 2360 area. That's where I would cut it, and then wait and see if you get a move closer to the 200. But so many of these names look like this. So many. I wish it were easier. It's not.
All right. Next name is going to be Microsoft.
Oh boy, this has been tough too. This to me is a broken trend, right? It didn't hold the 200-day moving average over here, and it broke, and it broke, and it tried to recapture, and it couldn't. Flush. You've got to look left. You've got this huge gap over here has been filled. I think a lot of traders are thinking, hey, that's a gap fill. I'm gonna buy it. And that gap filled right over here. I'm just gonna put that little dotted line, right? That gap filled right here. So the price is trading here. So some people, I think, their opinion is, you know what? If the gap rule is an 80-20 rule and it filled the gap, and it should fill the gap and price should reverse direction, you kind of already had that. So is it doing it a second time? You don't know, because it already filled, right? It filled over here and it bounced. So downward trend, 20 overhead curling down, 50 curling down, 200 curling down. You've got earnings in April. I don't see a reason to be long Microsoft in this current environment that we find ourselves in, not with the broad market trading sideways and all the global unrest. Markets hate uncertainty. If you like it long-term and you want to tuck it away, it's fine. I still think that there's more potential downside risk in Microsoft.
UPS.
Gross. Why did they choose brown? The horrible color.
What can brown do for you?
I know, it's just such a very, looks like a paper bag. All right, so 200-day moving average is supportive of price. If you like UPS in this spot, my opinion is that you might be able to get away with a trade. You might be able to get away with a trade to the long side. The area where I would tap out would be right here at the 200-day moving average. They've already tested it once. If they test it again and it fails, it has potential to keep going lower. And what do you have down here? A gap. So that the gaps always make me suspicious and cautious of taking a trade, but you're not taking that much risk here. All you have to do is say, you know what? I'll try it here. If it works, great. If it doesn't, I'm out at 95 bucks. Please don't average down in the face of something like that. Even if it bounces, you have low probability of that trade working if it breaks down below again. What else you got?
One of the more requested of them is GLD, gold.
Okay, so this is very headline risk. I don't know that gold really behaves well with technical analysis. I would say that if you have days like this where gold is selling, and it's selling, let's say, because of the headlines, and you want to buy it because you're buying it from a contra headline standpoint, it's one thing. But the technicals, the trend currently is up, but it's in jeopardy, right? You've broken the 20, the 50. They are now, the 20 is curling down, the 50 is about to curl down, price is underneath. So it's not behaving well technically. If you had more missiles flying and some really bad news coming out of the Middle East and the conflict in Ukraine, this probably spikes again. But to use technicals to buy like commodities like gold, oil, copper, silver, I think they're all going to have a very similar look. And I don't know that there's any advantage in using technicals on those commodity type names. I think they're hypersensitive to headlines. And I think you get very little edge out of using technical analysis on those names.
Yeah, and I would throw in too, if you guys are interested in more of like the silver and gold markets, we have someone that works with us, Smitty, who has a direct connection to the gold markets. If you guys ever are in the room, for those in the room, good person to ask and talk about for some of these commodities.
Yeah,
Ron.
He's an expert, by the way, in trading that stuff, and it's even given him fits. So
yeah, exactly. It's tough. Next one, ExxonMobil.
Exxon was having a day. So Okay, ExxonMobil. This is a stock that is in a solid uptrend, right? You got, look at back here in August, you had the 50-day moving average crossing over the 200-day moving average, curling up. That's referred to as a golden cross. So instead of the opposite was the death cross. So this way in the upward direction referred to as a golden cross. Price has been really good on the 50-day moving average, and if you were buying it off of the 50-day moving average, you're in great shape. You've got the 200-day moving average moving higher, 50 moving higher, 20 moving higher. The only thing I don't like is the distance from the 50 to the 200. That kind of can open the doors to some volatility. But what you can generally say about it is, hey, if Exxon has a crappy day and hits the 20 or hits the 50, it's probably a buy. But if you buy it up here expecting it to go higher, it might work, but you're running out of room for probability to continue on your side. Somewhere it's got to revert to the mean or catch a breather or blow off the amount of supply and restart itself. I don't know where that is going to be. This thing could, it could run another 100 points for all I know. All I know is the further that these get away, the more difficult it is up here to trade them. So wait for a crappy day on Exxon and come back and take a look and see if any of these technicals are holding up. And then that's probably the spot that it gives you for a shot. You still with
Sorry,
me?
Ron, I'm muted. This is one I don't even think I've ever pulled a chart of. I think it's an IPO, so I don't think there's going to be much technicals, but you could pull it up anyway. VCX. I don't think there's going to be much to analyze with 3 days of trading.
I don't know this name. So from a technical standpoint, there's just what Joe said. There's not
3 days.
I can't go off of anything. I don't know anything about the name. There are lots of IPOs that make moves like this only to sell off. I don't have anything that I can really use other than, like, if I wanted to use an anchored volume weighted average price, I could stick one right off of the open, blow this up a little bit, and I could say, all right, the current trend is up. It's very young. This is the supportive area right here. So that supportive area is kind of gets you like into this 124 area. But I don't think you're gonna really get anything useful out of technicals in that environment. I think this is probably just a market-driven wild card at this point. But if this is a name and you're involved, good on you.
Yeah, and this one is it's not even like an individual name really. It's Fundrise Innovation Fund. It's one of the first and largest public venture capital funds to list on the exchange. So makes it a little bit different. Next one is, and they kind of maybe tie in a little bit together, but it's Micron and then SMH.
Yeah, they tie together for sure. All right, so Micron is a semiconductor, but storage, right? So similar names to Micron. You've got like SanDisk, Western Digital. They're probably all going to look the same, right? Micron had a quarter that had very good earnings, and I think what you saw happen was there before earnings to go back to March 9th, and all of a sudden you had price that ran up, right? And it ran up into the number. This is a very typical type of move that happens in a good handful of names where they get a little beaten up or depressed. People start to question whether they have it right or not. Maybe it's because somebody bought back over here, or they bought over here, they bring price down, and then they run it up into earnings. And even though earnings were spectacular, they still sucked the air out of price. That's a very normal type of thing that you see. Now, what I do like about Micron is that it's in a pretty solid uptrend. What I don't like about it is the distance between the 50 and the 200. But look back in time, the 50-day moving average held up, it held up, it held up. So if you were to buy Micron on a day like this, what I would say to you is this is probably a good entry. And if it doesn't hold up below right here at this little wick, what is it, 400 and call it 50, I would tap out and I'd see if you get a day where it dumps a little bit more and then starts to recover. And if it starts to recover, then maybe that's your buy. So I think you would have to play with it a little bit, but just given the fact that this is a nice, solid, long-term uptrend and you're on the 50-day moving average and it continues to bounce off of it, I kind of like it for a long. But if remember, don't stick around. If you're wrong, you're wrong. You got to get out of the way.
And I'm assuming that most of the technical pitch is probably the same then on the semis if you want to look at SMH.
SMH. No, I think it's going to be different because it's got
a little different, yep,
mixed in, right? So yeah, that's a little bit different of a picture. You've got a longer term uptrend. There's your 200, and you do have price pulling back, and it's struggling at the 50 now, right? So whereas before it got below the 50 and it bounced, below the 50, bounced. Right now you got below, bounced, oh, but it came back, and now it's struggling to recapture it, right? Doesn't mean that it won't. If you like it as an area of entry and you buy it here, I don't think you stay in it below this low. I think you'll look to try and maybe rebuy it if it gets here. Like that's what I would do. I would set an alert and say if it's crossing down at that area, I'd be interested in being a buyer with some time on that area right in there. And if it doesn't bounce there, you step out of the way and see if it comes to test the 200 and you try again. But the wrong way to go about it, at least from my experience, has been you buy it here, you wait till it gets here, you add more. Oh, and then guess what? It keeps going and you're going to add more and add more. Adding that is a losing strategy. I would rather wait. If you buy it on a day like this, you just accept the fact that if it breaks down below that little low, you close it, you wait and see if you can do it again. But if you stay in there and you keep adding, you just keep digging yourself a hole and burning up your capital.
Next, a Nancy name, Palo Alto.
All right, so let me ask some of you guys a question. This is more of a cybersecurity name than a SaaS name. So I view it a little differently. However, it is still software, right? So I'm skeptical because of the heat that everything is taken. The technical picture is not a good one, right? This is a stock where the trend broke and you are currently in a downtrend, right? 200-day moving average price is overhead curling down. The 50 is currently keeping price in. The 20-day moving average is supportive. So is this little zone right here a sweet spot or not? I would say if you like it and you buy it, you got to cut it if you break back below the 20. Otherwise, maybe you get a pop. But look at, the price is tightening in between here. So is it a pinch where you get a run higher because the overall picture is a negative one? I say probability is low unless you get a headline. You get a headline, it can rip.
CrowdStrike.
I mean, look at how similar these are, right? Kind of the same thing on CrowdStrike as on Palo Alto Networks, right? If you like it here and you buy it, you want it long, you cut it at 403.91. So the question is, are you willing to take risk between 413.40 and 403.91? If the answer is yes, and you're happy with that, then yeah, you can take a crack at it. But this is not, from a longer term perspective, you don't have an edge to the upside. If you do get a move and you get to the 200, I would be taking my money.
Now we get to a Ron Chero favorite, Costco.
All right, Costco. All right, from a technical perspective, 200-day moving average is underneath price being supportive, but you see how that's just starting to tail off a little bit? It's still curling down a little bit. I'm not a huge fan of that. You had this move low to high. Let's take a look from a fib standpoint, where it was, where it went, where it's at currently. Okay, so you got to pull back here. This is the 618, and look at where the 50-day moving average is. It's in between the 618 and the 50. So I would say that if you can catch Costco on a red day like today, and you're looking for a trade, This isn't a horrible spot. However, if you do that and you stay in the trade below this little low right here, you're going to take on more risk than you're bargaining for. So can this continue? Can it touch the 200? And will it support? So if I buy it here, I got to be willing to take risks to here and get out of the way and then see if it's going to do that. Now, if all of a sudden you're in the middle of the day and that happens and you sell it and it goes down a little bit more and starts to come back, you can always re-engage. That's a very difficult thing for a lot of traders to do, is to say, I just took a small loss. Why am I going to jump back in? Well, you're going to jump back in if buyers show back up. You don't want to just jump right back in for the sake of, oh, it's showing me a blip or two. You've got to then switch time frames on your chart and see if you have an advantage to get in.
Okay, we got more HIMS. Do HIMS, coin, and then Transmedics.
HIMS is not a fantastic looking chart, right? It's trying to get through the 50-day moving average. The 20 is supportive. This little low right here, I wouldn't let it go below there if you're looking for, I think I might be able to get a pop trade out of this. From a long-term perspective, that's how I read it technically. Remember, I'm not taking fundamentals into account. I'm only looking at technicals. So when you get something like this, if you get a combination of technicals plus fundamentals, that's where you start to find an advantage, insider buying, etc.
Coinbase.
Now, coin has been a very nice condor of late. You guys see my spots right here, 217 and change.
Means Ron's looking at that name.
So let me move this up. This is a gap over here. So I'm likely to look at this on Wednesday and see if I can make money on a condor. The way that I trade condors is different than most, and I use condors as placeholders and aggressive positioning to see if I can catch a change in direction. Technically, coin is not in good shape. 200-day moving average is overhead price curling down. 50-day moving average is meeting up with the 20-day moving average. So the only thing you can say encouraging about it is this little area right here, 195.24, is currently kind of a spot where things are supportive, price is supportive. This is a gap. So you've got to be on your toes to make sure that this little gap isn't going to get filled. So if I'm looking at this, I'm thinking I want to sell both sides. And if it makes a move higher, I can morph it and ride direction higher, and I can morph it and ride direction lower if I need to. So for me, that's an aggressive trade setup. And if I get it wrong and it stays inside this area of price, I still get paid.
Okay, the next one is Transmedics, TMDX. Oof.
Didn't we see this name on, I thought we saw it on Friday. What day was this?
Yeah, this name sounds familiar.
All right, so here's an example of a company that had a positive trend. You can see that price was above 200, stayed above it, and now recently, what's wrong? You've got a break of the 200-day moving average. The 20-day, the 50-day are curling down. The 200-day is curling down. To me, that's a broken trend, and to me, this is a short. I would look at this and I would feel relatively comfortable. Did this gap fill? Like that would be my target area, and you'd have to look left and these little areas. If they give it up, then the potential of gap fill starts to get higher and higher. But right now, based on what I see here, to me that's a short, and earnings are May 5th. So that name to me is a short. And if you did short it, you'd want to be out at this one, at the high of today, this 117, call it 117.75-ish. That's where I would cut it. But that looks like a short to me.
All right, we have a couple more. CLS.
CLS. Celestica. Okay. This one doesn't look horrible. This is a longer term uptrend with short term starting to flatten out. Your 50s flattening out, your 20s flattening out. So these are pinching together. If price can consolidate inside of here and you like this as a trade, I think it's pretty good. The only thing that can get in your way and mess things up are earnings at the end of April. So you have time. I would say that you use the 200-day as your area of, if you entered here, you wouldn't want to let it slip past there. And maybe what you do is you wait for a day to see if it goes and challenges it. And if it goes and challenges the 200-day, that's probably a better entry than here. But I don't know if it's going to get here or not. It looks like it's just going to stay consolidated. Look at all the structure in here in this price area. So it might drive you nuts, and it might make you wait all the way until you get to earnings. You might just trade in that. You might just be consolidating all the way till earnings. So that one's a little tougher, but it is an uptrend, and these averages are starting to pinch together. So there is the potential for a move higher. There's also the potential for a move lower. You just got to be on top of it, set alerts. And if it does break lower and it breaks down technically, you probably want to get out of the way. And if you get your move to the upside, you probably want to look to take profits in some of these areas where it's had highs before.
Okay, we're gonna do a couple more, Ron, and then we'll cut it here. But CLS.
That's what we're on.
Oh, you did CLS. My fault. CLX. Sorry, I misread it.
CLX, Clorox.
Yeah.
Ouch. That's a tough one. You see how the 50 has crossed the 200. So some people would say, oh, but that's a golden cross. Well, the fallacy in that is that the 200-day moving average is still curling down. The 20-day is still curling down. The 50-day is starting to flatten out. So I can't call this confirmation of a positive and a move that's going to go higher. It tried and it broke down. So it's kind of a coin toss in here. You've got structure in here. If you wanted to buy a name like this here, you could, but I'd tap out below these lows. This we'll call it like 105. I would tap out and wait for it and see what else happens. You can't get every trade at the bottom. You can't get every trade at the top. You can try in a spot like that, but I don't think you have probability on your side in this instance. When are earnings? May 5th. So there's still some time. What else you
got? We have crack. CRAK, oil refineries.
Now, remember what I said about commodity names and names that are in commodity spaces. From a technical standpoint, this is a name and an ETF that's in a very positive uptrend. So if you're looking at oil and you like trading oil, or you want to be long oil names, this looks pretty good. You get to move back to the 20-day moving average like it had today. You can go ahead and buy it. And if it doesn't hold up, you sell it and you wait and see if you get a test of the 50. And if it hits the 50, you buy it and you wait and you see if it holds up. And if it breaks down, you sell it and you wait for the 200. But this is an ETF in an uptrend. That's a good solid uptrend. And I think that the way that you buy these types of names is when you pull back to those areas. I don't think you buy here and add. I think you wait for the pullback and then buy and then see what happens.
Okay. Ron, we got 3 names and then we'll cut it. So okay. The next one is APP.
Oh boy. Okay, this is a tough one. When it catches buyers, it's really good. And it's really difficult to catch this thing from a technical perspective. So overhead 200-day moving average starting to flatten out, 50-day curling down, coming to meet price along with the 20-day moving average, which is curling up. So if you really like APP, you wait for a stinker of a day, you buy it, you get a pop, you sell it. That's how I approach it. It's also, to me, inside of this range, you guys see I have an alert here and an alert here. This is also, to me, a condor name. So this is a name that will move in a big way. Like today it moved 16 and a half points. Like that's a lot. So if you can get yourself involved in a condor and you can catch a name like an APP for direction, you'll make a lot of money. But if you're just trying to trade it directionally, it can drive you a little crazy because you're looking for, how do I find the right spot to get in some? And on a name like an APP, you just have to wait for a day that looks really bad and buy some and pray. I don't like that. I like looking at, okay, give me a condor, because if it changes direction, I need one of these two areas to change, and then I can morph my trade and ride it directionally. But I don't think that APP is going to break out or down out of this range anytime soon. I think that these technicals are, they're not good, but they're not horrendous. But I don't think you have an advantage to the upside in the current environment. I think you have chop.
Okay, we get one that I don't think you'll be able to do much with, but maybe I'll be wrong. ABEO. They said they reported earnings last week and has an FDA-approved drug and an upgrade to 20. And I know these drug companies are a little bit different.
Yeah, so when it comes to like drugs or biotech or something like what you're asking about is, hey, it's got a great headline. I love the fundamental story, et cetera, et cetera. When it comes to like a biotech or a small name or a drug company, et cetera, you're not buying because of technicals. You're buying because, hey, if this breakthrough therapy happens, this stock goes from $4 to $50, right? But you can't use technicals for it. Like on a name like this, technicals for the most part are null and void. What I can say about it technically is that it's currently trading below the 200, the 50, and the 20. So do I see an advantage to buying it technically? No. But if you're buying it because you know something in regards to the therapy, the treatment therapy, it gets approved, it gets a code that insurers will now cover, and it's approved by the FDA, and it's it has a clinical trial that's double blind and peer reviewed and published in a periodical, et cetera. Like if you get all of those things, then the stock rips. But it's got nothing to do with the technicals. If only I'm looking at the technicals, this is a stop sign to me. It's like don't buy this. But if, like I said, you'd only be buying this based on a headline, right? And it does happen. It happens in drugs, biotechs. That's where you see that kind of activity. But it's got nothing to do with technicals.
MSTR, Ron, last one.
MSTR. All right. So again, the technical picture on MSTR is not great, and it's similar in its look to Bitcoin, coin, et cetera. They have similar looks. They're not all identical. They're similar looks. From a technical perspective, the positive is that the 20 and the 50-day are finally starting to flatten out and pinch. Will you get a move higher? I don't know. The 200-day moving average is overhead, keeping price in check. If you like it for the long term, some positives that you can say about it is that you have price structure in this area over here. Will it ever look like this move to the upside or this move to the downside again? I don't know. And it does also rely a lot upon Bitcoin, and Bitcoin doesn't really respect technicals either. And you get things that people talk about, for example, oh, well, one of the reasons Bitcoin is down is because Iran was the largest miner of Bitcoin, and it had the lowest cost per coin because of the energy consumption. And if that all of a sudden is offline and that's what's keeping this down, and let's say that war, that conflict ends and things start to return to normalcy, theoretically, Bitcoin should pop. Theoretically, this should pop. So you guys start to see a little bit how technicals help And then a lot of times technicals really don't mean anything. Or if you're in an environment like the biotech that we just looked at, like technicals go completely out the window when something catalytic comes into play like that. So I really don't know if that story about Bitcoin mining is true and if that's directly related, but they're going to look very similar. See how they look so similar? So I think that the trade on MSTR is kind of a proxy to trading Bitcoin. At least that's my opinion.
Okay. If we missed any of your names, my apologies. We have to cut this somewhere, or Ron will be here for another hour. But at that point, he might be able to drink tequila. So
I was going to see, then I'll start drinking tequila.
Then he'll start getting boozy. But I think we covered absolutely most of the names here. And again, Ron, this is just kind of giving the quick technical picture. If you guys want to get more into the weeds, Ron does a members-only stream every week on Wednesdays, typically, unless there's a day off in the market, where he talks about different trades that he's looking at, and people kind of bring their names, and he can help you on how to trade it, or if you're stuck in a position, what you could potentially do to help yourself get out. So if you guys are interested in that, we're running a promotion now for the next week, 7 days free, 50% off your first month of the Steam Room with code WSJ50. You can see it on the screen right now. It's also in the description below. And Ron will be back again on Monday. We're going to do this as a weekly thing unless he's traveling. So we'll catch you guys on the next one. Ron, feel free to give any parting words.
So just keep in mind, like what we talked about today, that's all big picture stuff, right? So it's not the only thing that we do. I would call myself, and I would call Joe, a hybrid trader. So we are interested, what we would love is to be able to catch a trending market and get in long-term names and ride them. In the current environment, we have to adapt our trading to fit what we get. And right now that means we scalp. So we also have another room we refer to as the 0-day room. And when you're a Steam member, you have access to that as well. And I really enjoy being a hybrid trader. So for example, today I looked at and did nothing to the long term. We did that on Friday, where we bought, because of all of the stuff that we look at, we were able to buy some 30-day, 40 to 45-day out SPY calls going into the weekend because certain things criteria were met. We'll teach you that. And obviously we sold those for a nice profit. And then otherwise we'll go in and we'll scalp on a day-to-day basis. And when and if a trending market returns, we'll have profits from scalps to put to work in those longer term trades. So it's kind of a combination of understanding what the market gives you and how do you take advantage of what the market gives you. You can't force your strategy on the market, but you can adapt and use different strategies if you recognize and understand the environment that you're in.
Awesome. All right. For those that are in the room, we'll see you guys there. If not, catch you guys on the next live stream on Monday. Ron, thank you.
Thanks, Joe.